Welcome to our illustration on the ledger and the concept of double entry. So you have this question that we have Ahmad's financial position as at 1st August 2014. As at 1st August 2014 was as follows. So he had cash in hand, that is 6,300 shillings. He had cash at bank, that is 24,000 shillings, and he had stock of 36,000 shillings. Then we are required to open Ahmad's books by means of the journal and enter the foreign transactions and extract a trial balance. So we have the following transactions. So we are required to do three things: do the journal, and then we enter the foreign transactions in the ledger, and then we extract the trial balance. So now I haven't covered the journal. I haven't covered the journal, but let's do it as an example. So the journal is basically a chronological record of business transactions. So a journal in business is basically a chronological record of business transactions. So like you have your own personal journal where you record your activities that you undertook during a particular day. Like today on Sunday, I did this, I went to church, I went to visit my friends and relatives, and the day ended. So in the same case for businesses, they also may keep journals, which is basically a chronological record of business transactions. That on this particular day, these are the transactions that took place. So a journal will be prepared as follows. So we have it as the journal. So the journal will have 4 columns: one for to record the dates. We have one for the particulars. We have a column for the debit, and we have a column for the credit. So we do that. So this is our journal. So we draw the columns. The columns. So we begin our journal, the date. So as in the question on the first day, the business had the following items. It had cash in hand, 6,300 shillings. It had cash at bank, 2,400 shillings, and it had stock, 3,600 shillings. So this was at the beginning of the period. So we have cash in hand, which is an asset, cash at bank, which is also an asset, and stock, which is also an asset. There's one thing that is missing. So you don't have liabilities and you don't have capital. So this only gives us one side of the ledger, or the debit side. Yeah. So remember we said that in accounting there has to be an equation between the two sides of the ledger, that is the debit side and the credit side. So this only gives us the balances on the debit side. So you don't have something to equate on the credit side of the ledger. Yeah. So the credit side of the ledger. So one thing that is missing here is the liabilities and the capital. But you're not given the liabilities. So the liabilities don't have to be there. But the capital has to be there. For any business, the capital has to be there. And remember in our first lesson, we talked of the accounting equation. And in the accounting equation, we talked of the assets. The assets being equal to capital. You remember that? Capital plus liabilities. So in this case, in our equation, we don't have the liabilities, but we have the assets. So the assets we have cash in hand, which is equal to, in our case, 6,300. So please bear with me. This needs a lot of technical. So capital Cash in hand is 6,300. Then you have cash at bank is 2,400. And you have capital. Stock. Stock is another asset. Stock is an asset. That is 3,600. So you have those three items at the beginning. So you don't have liabilities, but you must have capital. So in total, our assets are equal to 6,300 plus 2,400. That is for cash 6,300 and bank 2,400 plus 3,600 for stock. So total assets is therefore 12,300. So capital from the balance sheet equation is equal to assets minus liabilities. Liabilities, capital is equal to assets minus liabilities. So we have the assets is equal to 12,300, but we don't have liabilities. So liabilities is 0. So in short, our asset is equal to, our capital is therefore equal to 12,300 capital. So at the beginning, the capital of the business is equal to assets minus liabilities. So in our case here, you don't have liabilities, so 0. So the asset is basically in our case here equal to the capital. So assets is equal to the capital because you don't have liabilities. So the capital of the business at the beginning is therefore basically 12,300. So that has to be noted. So you have capital of 12,300. So the duality effect. So at the beginning here, you only have the asset side. So to equate that, then use the accounting equation to determine how much capital it is. So then now we proceed to our the journal. So at the beginning, the journal that is on 1st August 2014. So you can have it as 1st, maybe August 1. What is this? August 1st. We begin with the items that are there. So cash, you have cash in hand, which is cash in hand, the amount is 6,300. So assets in the trial balance will always be on the debit column. So assets, okay, sorry. Yeah, the assets will always have a debit balance. So the debit balance at the beginning will fall in the debit column. Then the other item we have is cash at bank, which is 2,400. Then the other item is stock, which is 3,600. And then we have the other item is capital. So you have to equate this. The two sides of the ledger have to be equal. And our capital, as we have found, is 12,300. So that is the opening part of the journal. So this is the journal that we are preparing. So then the journal must have a narration, and in the narration you can say being the opening balances as at 1st August. So and then you close that. So to close that, we underline, and then we move on to the second transaction, the transaction on August 2nd, as I've highlighted there. So August 2nd. So I hope you can. I hope the video is clear to you. August 2nd. So you are told that purchased goods in cash, 4,000 shillings. Purchased goods in cash, that is 4,000 shillings. So the concept of double entry, yeah, from the first part of this video, the concept of double entry, we say that there are 3 questions to be asked, and we apply these in the classification of accounts. So the first question that we need to ask and answer is what type, which 2 accounts have been affected. 2 is what type of accounts are they, and 3, which account is to be debited and which account is to be credited. So for this transaction, which 2 accounts have been affected? So from in this case, we have purchases account and we have cash account. So we have purchases and we have cash account for this transaction. So purchase goods in cash, 4,000 shillings. The 2 accounts is purchases account and cash account. So the second question is what type of accounts are they? Purchases is an expense, cash is an asset. Purchases is an expense and cash is an asset. And then that question is which account is to be debited and which account is to be credited. So for purchases account, we have incurred purchases, which is an expense, yeah? So this is an increase in an expense. And we said that whenever an expense increases, we debit. So therefore we debit purchases account. And then for cash account, cash will decrease. Cash has gone out. It has been paid to the supplier. So cash account has decreased. So cash being an asset, whenever an asset is decreasing, we're supposed to credit the assets account. So in this case, cash account is an asset, and this asset is decreasing, so therefore we credit cash account. So therefore, debit purchases, credit cash. So debit purchases in the purchases column, that is 4,000 shillings. Sorry, 4,000 shillings. And then credit cash account. Credit cash account. Credit cash account, 4,000 shillings. Then there has to be a narration. The narration, we put it in brackets, being, can say being purchases. Made. Close that. So to close that, we underline. So like that. Then we move on to the second transaction. That is on 5th of August. Bought goods from Kamal on credit. So August 5th. August 5th, bought goods from Kamal on credit. So the 3 questions still have to be asked and answered. 1, which 2 accounts have been affected? What type of accounts are they? And which account is to be debited and which account is to be credited? So bought goods from Kamal on credit. So in this case, the 2 accounts is purchases and Kamal. So on credit, there is no cash that has been paid. So in this case, we'll have the account of Kamal as a creditor, as a personal account. So therefore, we shall have purchases account and Kamal account. Kamal's account, Kamal being a creditor of the business. So purchases and Kamal's account. So what type of accounts are they? Purchases is an expense, Kamal is a creditor. A creditor is a liability. So they are together. So purchases an expense, Kamal a creditor, and a creditor is a liability. What happened? Then that question, which account is to be debited and which account is to be credited? So purchases will always be debited whenever they increase, will always be credited whenever they decrease. So in this case, we are incurring more purchases. Purchases have increased, so therefore we debit purchases account. Kamal's account being a creditor, being a liability, this liability is increasing. Yeah. So we are owing more to Kamal. So the liability being that the liability is increasing, we credit Kamal's account. So therefore, debit purchases, credit Kamal's account. And we do that. So debit purchases, account by 17,500, and then credit Kamal's account by 17,500. So, and then we insert a narration, say being purchases made on credit. Then you close that. So help you are together. You are together. Then you move on to the third transaction, 7th of, let me drag this down a bit. We move on to the third transaction, that is on 7th of August, both shop fittings and paid by check. So for us to record this in the journal, so which two accounts have been affected? Which two accounts have been affected? One here is the shop fittings account, and these shop fittings have been paid for by check. So the other account is bank account. So shop fittings account and bank account. What type of accounts are they? Number two, shop fittings is an asset, bank is also an asset. So shop fittings is an asset, bank is also an asset. And then the third question, which account is to be debited and which account is to be credited? Being that both are assets, shop fittings are increasing. They are coming in. So we debit shop fittings, and then bank account is decreasing, is going out. So therefore we credit bank account. So debit shop fittings, credit bank account. So that is August 7th, 7th, not 17th. August 7th, debit shop fittings by the amount is 2,400, and then credit bank account by 2,400. Then we need to have a narration, say being shop fittings purchased. Then you close that. Then you proceed to the other transaction, that is cash sales, that the business of Ahmad sold goods and received cash, sold goods on cash basis. So cash sales. So in this event, in this transaction, so the three questions to be answered. One, which two accounts have been affected? So the two accounts here is cash account, and the other account is sales account. Cash account and sales account. What type of accounts are they? Cash is an asset, bank, cash is an asset, and then the other account is sales. Sales is a revenue. Cash is an asset and sales is a revenue. And then the third question to be answered is which account is to be debited and which account is to be credited. So in this case, cash account, cash will be increasing, yeah? So we will be receiving cash. So cash will be increasing, therefore we debit cash account. Cash is coming in, cash is increasing. So therefore debit cash account, being that it is an asset that is increasing. And then sales account, sales are revenue, and we said that whenever revenues are increasing, we're supposed to credit. And in this case, the sales revenue is increasing. So therefore, credit sales account. So therefore, on August 11th, debit cash, the amount is 2,800, and then credit sales, the amount being 2,800, and the narration being cash sales made. So you proceed downwards. So allow me to extend this trial balance. The trial balance tends to be a very long, sorry, not the trial balance, but the journal tends to be a very long document. So you may spend most of, not less than even 3 pages of your book. So that is 11th of August. Then we have 17th of August. Sold goods to Kasimu on credit. Sold goods to Kasimu on credit. So the two accounts here. So the first question, which two accounts have been affected? So the two accounts here is sales and Kasimu. So the business has sold to Kasimu on credit. So no cash has been received, no bank amount has been received. So therefore it's on credit basis. So the two accounts here is sales account and Kasimu's account. Sales account and Kasimu's account. So what type of accounts are they? Sales is a revenue and Kasimu is a creditor, of which a creditor is a liability. So therefore sales is a revenue and Kasimu is a liability. So in this case, and the third question we answer is which account is to be debited and which account is to be credited. So sales account, so sales are increasing. We are earning more sales. So therefore, credit sales account. And then Kasimu is not a creditor. Kasimu is a debtor. Yeah. So we've sold to him on credit basis. So he owes us. So he's a debtor. A debtor is an asset. So please apologies for that. So sales is a revenue, Kasimu is a debtor, and a debtor is an asset. So sales is a revenue, Kasimu is an asset. Sales is increasing. Sales being a revenue that is increasing is supposed to credit. So credit sales account. And then debit Kasimu's account. Kasimu is an asset. This asset that we have in Kasimu is increasing. Or rather, you can say that Kasimu is our receiver, and we always debit receivers whenever they receive. So Kasimu is receiving, therefore we debit Kasimu's account. Kasimu is an asset. This asset is increasing, so therefore debit Kasimu's account. Debit the asset account that is increasing and credit the revenue that is increasing. So therefore, debit Kasimu's account, but the amount is 850, and then credit sales account. Credit sales account, the amount is 850. The days, when is the date? 12th. It's August 12th. And then we have the narration, say being sales made on credit. Simu. And then you close that. And then the second transaction we have 15th of May, of August. So 15th, so Aug 15th. So 15th of August, paid Kamal by check. Paid Kamal by check 10,000 shillings. Paid Kamal by check 10,000 shillings. So in this case, the two accounts, the first question, which two accounts have been affected? So the two accounts here is Kamal's account, and the other account is bank. So Kamal has paid us, so Kamal's account and has paid by us by check, so the other account to be affected is bank account. So what type of accounts are they? Kamal is a creditor, a liability, and check, the bank account is an asset. So therefore we have Kamal, a liability, and the bank account, an asset. So the liability is decreasing. Kamal akitulipa, the liability in him is reducing. And then the bank account will also reduce because we withdraw money from the account to pay Kamal. So both accounts here are decreasing. So the Kamal account is decreasing, the bank account is decreasing. Kamal being a liability and it's decreasing, we are supposed to debit. Liabilities should always be debited whenever they decrease. And assets should always be credited whenever they reduce. So therefore, credit Kamal's account and debit, debit Kamal's account and credit the bank account. Yeah, so the three questions, the two accounts is Kamal's account and bank account. The question number 2, what type of accounts are they? Kamal is a liability, bank is an asset. And the third question, which account is to be credited and which account is to be debited? We credit bank account because the bank is decreasing, being that the bank is an asset, and then we debit Kamal's account, being that the creditor in Kamal is decreasing. So therefore, debit Kamal's. I hope with my confusion in my talking that you're understanding what I'm saying. Yeah. So Kamal's account, we debit. The amount is 10,000 shillings. And then we credit bank account because our bank account has declined. So bank account. So the amount is 10,000 shillings. Then the narration being payment made to Kamal. Close that. Then move on to the other transaction, cash sales of 4,700 on 18th. So August 18th. August 18th. August 18th. August 18th. Cash sales of 4,700. So the first question, which two accounts have been affected? And the two accounts here is cash account and sales account. So it's sold goods, received cash. So cash account and sales account. The second question, what type of accounts are they? Cash is an asset, sales is a revenue. And then the third question, which account is to be debited and which account is to be credited? Cash is an asset. In this case, cash is coming in, so therefore debit cash. And then sales is a revenue, and whenever revenues are increasing, we're supposed to credit it. So in this case, therefore, we credit sales account because the revenues that we have in sales are increasing. So therefore, debit cash account, the amount is 4,700, and credit sales account. Credit sales account. The amount is 4,700. So narration being sales made by cash. Then we close that transaction in the journal. Then we proceed. Then we proceed and we drag this downwards. So we drag after August 18th. Another transaction we have is paid cash into bank on 19th. So August 19, paid cash into bank. So alitoa pesa kwa biashara akaenda akadeposit kwa account yake ya bank. So the two accounts here, the first question is cash account and the other account is bank account. Cash account and bank account. What type of accounts are they? Cash is an asset, bank is an asset. Both are assets. Which account is to be debited and which account is to be credited? Cash account, cash will be decreasing. So credit cash, and then our bank account will be increasing, so therefore debit bank account. So August 19. So debit bank, credit cash. The amount is 800. So 800. And then narration being cash deposited into bank. That, then you close that. Then you close that transaction. So I hope you are together. So you have the debit column and you have the credit column. So I hope you've noted where you are putting the debits and where you are putting the credits. And then here in the particulars, the debits are on the margin and then the credits are somewhere inside the margin. I hope you are noting that. So then move on to the other transaction on 20th of August. Ahmad withdrew goods for his personal use. Ahmad withdrew goods for his personal use. So the two accounts here is drawings and the other account is purchases. So in this case, Ahmad took out goods for his personal use. Yeah. Ni kama maybe alikuwa na kiosk, so alienda akachukua unga, sukari, akapeleka kwake kupika wakule na familia yake. So in that case, he has withdrawn. So whenever the owner of the business takes out something, either cash or bank or goods from the business for his personal use, that goes to the drawings account. Yeah, I'm withdrawn, so it's taken out from the business. So that goes to the drawings account. So drawings is a deduction in capital, and capital, whenever capital decreases, we're supposed to debit. So therefore, we shall debit drawings account. So in this case, he withdrew goods for his personal use. So when the owner takes out goods for his personal use, or when the owner withdraws goods for his personal use, then we post that in the purchases account. We post that in the purchases account. And because in this case, the purchases will be decreasing, and purchases being an expense that is decreasing, therefore we are supposed to credit the purchases account. Whenever an expense is decreasing, we're supposed to credit. Whenever it is increasing, we're supposed to debit. So in this case, the purchases account is decreasing, or rather it is reducing. So therefore we credit purchases account. So therefore we debit drawings account in this case, and credit purchases account. So that is on 20th. So Aug 20th. So we debit drawings. The amount is 300, and credit purchases. $300. Then we put the narration being drawings of goods by the owner. Being drawings of goods by the owner, and then we close that. To close, we underline. Then we move on to the next account, the next transaction, still on August 20th. August 20th, what happened? Paid carriage and cash. So which two accounts here? One is carriage, the other is cash account. So you have two accounts, carriage account and cash account. What type of accounts are they? Carriage is an expense. Carriage means transport in this case. So carriage is an expense, cash is an asset. 3, which account is to be debited and which account is to be credited? Carriage being an expense that is being incurred, yeah, that is an expense that is increasing, we debit. So we debit carriage, and then cash is reducing. So cash being that is an asset that is reducing, we're supposed to credit. So therefore, debit carriage, debit. So debit carriage and then credit cash. So carriage, debit, the amount is 200, and then credit cash. Cash account, the amount 200. So on the narration, being carriage. Carriage is a transport expense. Being carriage paid. Then we close that. To close, we underline. Then we move on to the other transaction on 23rd. So August 23rd. August 23rd. bought goods from Mantau in cash. Bought goods from Mantau in cash. Which two accounts? One, Mantau, and the other account is cash. Bought goods from Mantau. Mantau, what type of accounts are they? Mantau is a creditor is a liability. Yeah, so to us. Oh, sorry. Okay. The two accounts here is not Mantau and cash. The two accounts here is purchases and cash. So Mantau has we've bought from Mantau and paid him cash. So therefore, in the two accounts here is cash account and purchases. Cash and purchases. Yeah. So being that Mantau has paid us, therefore now we do not need his account. That being that we have paid Mantau, we do not need his account because we do not hatudai kitu yoyote, so hakuna account tutatengeneza yake. So as such we simply have cash account. So therefore purchases and cash. What type of accounts are they? Purchases is an expense and cash is an asset. And then the third question, which account do we debit and which account do we credit? Purchases is an expense. Whenever an expense is being incurred, we debit that expense. Cash is an asset. Whenever cash is decreasing or whenever cash is reducing, we credit. So in our case here, cash is reducing. Therefore, we credit cash, being that the cash is an asset and the asset is reducing. So therefore, debit purchases, credit cash. So purchases, and the amount is 640, and then credit cash. Cash, and the amount is 640. Then we have the narration being purchases made. Then we underline this. Then we move forward on 27th, sold goods to Kenneth on credit. Sold goods to Kenneth on credit. So August 27th, sold goods to Kenneth on credit. So which two accounts here? The two accounts here is sales and Kenneth. Kenneth hakutulipa. So we need to have an account for Kenneth. So sales and Kenneth. What type of accounts are they? Sales is a revenue, Kenneth is a debtor, and a debtor is an asset. So that question, what do we do to which account do we debit and which account do we credit? So sales is a revenue that is increasing, so therefore debit sales. And then Kenneth, sales we credit. Revenues, whenever revenue is increasing, we're supposed to credit. So therefore credit sales. Kenneth is an asset, is a debtor, and this asset is increasing. So therefore we debit Kenneth account because this asset is increasing. So debit Kenneth account, and then credit sales account. Credit sales account, and the amount is 1300. 1300. The narration shall be being sales made on credit. And then we close that. To close, we underline. Then we move on to the other transaction on 28th. Bought a new bicycle and paid by check. So on August 28th, bought a new bicycle and paid by check. So August 28th. So which two accounts here? Bank account, being that a check was used to pay. So bank account, and then bicycle account. Bank account and bicycle account. What type of accounts are they? Bank is an asset and bicycle. Also, the bicycle is also an asset. So yeah, therefore we have bank account and bicycle account, of which both are assets. And then the third question, what happened? Which account do we debit and which account do we credit? So the bicycle is coming in, so therefore debit bicycle account, and the bank is going out, money is going out of the bank, so therefore credit bank account. So therefore debit bicycle account, debit bicycle account, and then credit bank account. So to credit, we put it inside the margin. The amount is 4,000. We credit 4,000 in the bank account. Then we put the narration being bicycle purchased. We close that. Then we move on to the other transaction on 31st of August. Paid rent of premises by check. So which two accounts here? One is rent expense and two bank account. The rent was paid by bank by check. So the two accounts is rent expense and bank account. What type of accounts are they? Rent is an expense, bank is an asset. Rent, which account is to be debited and which account is to be credited? Rent is an expense, and this expense is increasing, so therefore debit rent expense. And then bank is going out, is decreasing, so therefore we credit bank account. So debit rent expense and then credit bank account. And the amount is 2,500. 2,500. We have the narration being rent paid. Then we close that by underlining. Then we move on to the last transaction. That is, Ahmad withdrew cash for his personal use on 31st of August. 31st of August, Ahmad withdrew cash for his personal use. So the two accounts here is drawings and cash. So drawings being that he has taken out goods for his own use. So he has taken them away from the business. Maybe amezichukua kwenda kulipia watoto wake school fees. So therefore the accounts here we have is drawings and cash. So cash being that cash has been taken out of the business. So the two accounts is cash and drawings. What type of accounts are they? Drawings is a deduction in capital. So drawings is part of capital, and then cash is an asset. So which account is to be debited and which account is to be credited? Drawings we debit because the drawings is a deduction in capital, and whenever capital is reducing, we are supposed to debit. So therefore, debit drawings. Cash is an asset that is decreasing or going out. So therefore, we credit the asset. So therefore, credit cash, debit drawings. So we do it as it's supposed to be. So we debit drawings and credit cash. Cash, the amount is 500, and credit 500 for cash. Narration being drawings. Cash by the owner. That is it, and then you close that. So that is the end, and that is how we prepare the journal. So next, we post those transactions in the ledger, and then we balance off the ledger and prepare the trial balance. And then we prepare the trial balance. So you have to do that in the next video. So thank you.